Joining us right now to talk more about that is CFRA Director of Equity Research, Ken Leon. Ken, it's good to see you this morning. We've got a whole bunch of earnings to talk with you about, and it is certainly a mixed picture. Tell me your assessment of what we've learned so far from the banks.
So you just want to get through the third quarter. It's the seasonally weakest quarter. JP Morgan did fine. You have to remember that September drives the third quarter. And obviously there was low market volatility, lower investor activity. The key driver, and I want to thread the performance to the discussion about the midterm elections, the consumer and the consumer bank has driven all these banks. Those numbers are still very good in the third quarter across credit card and consumer loans. Interest spreads are great. I beg to disagree on the discussion of a change in terms of midterm elections. The Federal Reserve and the agencies are highly coordinated, more pragmatic. You got great leadership below Chairman Powell with Randy Quarles and others. So I think with the proposed rulemaking coming out of the Fed and the agencies, the banks finally, after 8 years, get consistency, transparency, and that is really what drives policy and regulation. In this case, it's not Congress.
All right. All right.
I just wanted to go back to your view with respect to kind of going into the fourth quarter and beyond. Where do you see the kind of inflection point between net interest margin and loan growth?
Great. So in terms of both are the two key drivers of net revenue. Spreads are still pretty good in the third quarter and will continue. There could be some pressure on what is called deposit betas, but generally still fine. I think the big kick-up in the fourth quarter is the M&A pipeline. In the first half of this year, it was the highest since 15 years. Third quarter was kind of a digestion period. It is concentrated to mega deals being 50% of global M&A. Banks like JP Morgan and Citi will really benefit. The other point, because Citi is more of a global footprint with their consumer bank, but generally for JP Morgan and Citi, in the case of JP Morgan, 75% of the revenue is North America and Europe. So I'm not too concerned about China or Asia Pacific, a little bit for Citi.
Just to follow up, when you talked about the consumer banks and, you know, credit cards and kind of how the consumer is driving, I mean, I think we're going to see probably auto loans get reduced. We're probably going to see home ownership with respect to lending be reduced because 5% interest rates. So really you're talking about credit card debt. And my concern, even though leverage is up a big into credit card debt, aren't you going to eventually be concerned maybe on the whole default aspect to it if we see some sort of slowdown?
Sure, it's a great question. And over the last few quarters, the large banks, unlike non-bank credit card issuers, are tightening credit standards. So it's really for the high FICO scores. Actually, the non-performing loans and credit cards, in the case of JP Morgan, was down year over year. But, you know, that's the best question because I need consumer banks to drive the outlook for these large banks.
And you don't have any worry about the consumer going into 19 and 20?
So the underpinnings is clearly job growth and household income. Those are still very good. I would think that if we're going to see any concern, it would be if we see an increase in delinquency and defaults for credit cards, especially.
Because one of the top stories yesterday and today is mortgage rates nearly to 5% this week, highest point in over 7 years. You've been talking about this.
Yeah, for sure. And go ahead. Sorry, Ken.
Yeah, I would say, you know, the direction has been lower new mortgage originations. The refi opportunity was over about 3 quarters ago. So mortgages is still a negative print on any of these banks. The auto loans, you and I, if we go out and try to finance a new car today, you can't get 0 or 1%. You know, so if you look at the mix and the trajectory of growth, it's really credit card and consumer loans. It's not auto, and it's definitely not mortgages.
Right.
Hey, Ken, just real quick, the market has been spooked by higher interest rates the last few days. When you look out to 2019, do you factor in 3 rate hikes? And if you only got 2, would you see that as a positive for the market or the banks in particular?
So I'm not an economist, but I hope for the banks, we get 3 or 4 rate increases. The biggest debate is a level higher related to the spreads between the 2 and the 10-year and what effect it has on the banks. In the more micro world of the banks, the spreads are still good in what they have across their businesses. But yes, that's the big risk. And the market right now is very skeptical.
All right, Ken. And I know you're buying Bank of America and J.P. Morgan, but you're holding on Citi, right?
Holding on Citi and a sell on Wells Fargo.
A sell on Wells Fargo. Is that just the negative headlines?
No, we've had a sell for a period of time.
Thank you so much, Ken. Ken Leon joining us there.